So, let's talk about employee stock options. You know, that part of your compensation package that can feel like you've just won the lottery, or sometimes like you're staring at a ticking tax bomb. Today, we're going to break down what you're holding and how to make sure it's the good kind. And look, that's not just a catchy headline. It's a very real financial fork in the road. By the time we're done here, you're going to know exactly which path you're on, and more importantly, how to navigate it. Okay, first things first, and this is super important. A stock option is not actually stock. Not yet, anyway. Think of it more like a special coupon. It gives you the right to buy a company's stock at a locked-in price from the past. That price is your strike price, and the gap between that and what the stock is worth today, well, that's where all the magic happens. Now, every option goes on a pretty standard four-step journey. It all starts with the grant. That's day one, when the company gives them to you. Then comes vesting, which is just earning them over time. Then the big one, exercise. This is when you pull the trigger and actually buy the shares. And finally, the whole point of this, the sell, turning all that paper value into actual cash in your pocket. But right from the very beginning, from that grant date, your options are sent down one of two very different paths. And trust me, the path you're on is going to change everything about how you handle them. So let's meet our two main characters. On one side, you have incentive stock options, or ISOs. Think of these as the high reward option, packed with potential tax advantages, but also a ton of strict rules. And on the other side, you've got non-qualified stock options, or NSOs. These are way more common, much more flexible, and a whole lot simpler. And wow, are they different. Just look at who gets them. ISOs are a special deal, for employees only. NSOs? They can be handed out to pretty much anyone. Employees, contractors, you name it. But here's the real kicker. The reason NSOs are everywhere. The company gets a nice tax deduction when you exercise them. That's a massive win for employers.
So when does this all actually start to matter? Well, the first big moment of truth is when you decide to exercise your options. This is a huge financial move, and for ISOs and NSOs, the tax consequences are like night and day.
All right, so with an NSO, the second you exercise, bam, the tax man shows up. You owe ordinary income tax on your paper profit, that spread between your low strike price and the current market value. But if you exercise an ISO, nothing. No regular income tax bill. It sounds like a dream, right? A perfect tax loophole? Well, not so fast. The IRS always has a trick up its sleeve.
And this is that NSO tax bomb in action. Just imagine. You exercise 15,000 options. Your strike price is just $3, but the stock is now worth $35. The IRS looks at that $32 difference on every single share and calls it income. All of a sudden, you could be looking at a tax bill for over $200,000. Cash you have to find and pay right now, on stock you might not have even sold yet.
Okay, so ISOs are the clear winner then, right? I mean, you get to skip that massive upfront tax bill. But hold on. ISOs have their own secret weapon, a hidden trap that can snap shut the moment you exercise, even if you don't sell a single share.
And that trap has a name, the Alternative Minimum Tax. You'll hear it called the AMT. And believe me, if you have ISOs, this is one acronym you absolutely cannot afford to ignore.
You know, the easiest way to think about the AMT is like a shadow tax system. It's a whole separate set of rules. So every year, you basically have to calculate your taxes twice, once the normal way, and again using the stricter AMT rules. Then the IRS just looks at both numbers and says, yep, you owe us whichever one is higher. It's their way of making sure nobody uses too many deductions to get their tax bill to zero.
And here is exactly how your ISOs can spring that trap. So you exercise your options, but you decide to hold on to the stock. In the regular tax world, no big deal. But in the shadow world of the AMT, that entire paper profit you just made, it gets added right on top of your income for the year. And that can be more than enough to trigger a massive AMT bill, a tax bill on money that for you still only exists on paper.
Whew, okay, so you've made it through the exercise, you've dealt with the immediate tax headaches. Now for the main event, selling those shares. This is it. This is when the paper profit becomes real money, and once again, the rules for how you do this are totally different.
Hey, remember all those strict, annoying rules that come with ISOs? Well, this is where they finally pay off. Because if you have the patience and the discipline to follow two key timing rules, you can unlock the absolute best tax treatment possible on your profits.
And here they are. Write these down, the two golden rules. You have to sell your shares more than 2 years after they were first granted to you, and you have to sell them more than 1 year after you exercise them. It's not one or the other. You gotta hit both to win the tax game.
If you nail both of those timelines, congratulations, you've just made a qualifying disposition. That means your entire profit, from your strike price to your sale price, gets taxed at the much lower long-term capital gains rate. But if you miss even one of those deadlines by a single day, it's a disqualifying disposition, and a painful chunk of your profit gets taxed at the same high rate as your salary. Ouch.
And just look at what a staggering difference that makes. We're talking about paying maybe up to 37% or more in ordinary income tax versus a max of 20% for long-term capital gains. On a really big profit, that's not just a little bit of savings. That can literally be the difference between a down payment on a house and, well, not a down payment on a house.
All right, so after all of that, how do we actually put this into practice? Let's try and boil this all down into a simple, winning strategy. One that makes sure you're holding a lottery ticket, not that tax bomb.
You know, it really comes down to this. First, and I can't say this enough, know your type, ISO or NSO. That question is the foundation for everything else. Second, have a plan for the cash you'll need, and always watch the calendar. Exercising costs money, and timing is everything for taxes. And look, if there's one thing you take away from all this, please let it be this. Don't try to figure this out alone. This stuff is complicated, and a good tax professional can save you from a mistake that could cost you thousands.
So there you have it. You know the rules of the game now. You know the two different paths, you know the hidden traps, and you know where the big prizes are. Your stock options aren't just some random number on a piece of paper anymore. They're a series of choices that you get to make. So the only real question left is, what's your next move?